Okay, stop whatever you're doing right now, because I need you to hear this. Bank of America, one of the biggest, most powerful financial institutions on this planet, just put out a forecast that genuinely made me stop and read it 3 times. Not because it was confusing, but because the number was so extreme, so audacious, so far outside of what most people are talking about, that I had to make sure I wasn't misreading it. They are projecting silver could hit $309 per ounce this year. In 2026, not in 5 years, not in a decade, this year. Now, before you roll your eyes and think this is just another hype video, just stay with me, because I'm going to show you exactly where that number comes from, why a bank of this size is even putting it on paper, and most importantly, what it actually means for everyday investors right now. This is not speculation. This is not a crypto bro on social media. This is Bank of America's head of metals research, and the math behind this forecast is something you genuinely need to understand. Let's start with who is actually saying this, because credibility matters. The forecast comes from Michael Widmer, Bank of America's head of metals research. This is not someone posting on Reddit. This is not an anonymous analyst. This is the man whose job it is, whose entire career is built around understanding precious metals markets at the deepest possible level. And when Michael Widmer puts a number like $309 in an official Bank of America research report, Wall Street listens. His report, published earlier this year, has since been described as one of the most extraordinary precious metals forecasts in modern financial history. Multiple financial news outlets, finance magnates, The Street, The Deep Dive, Kitco News, all picked it up and said the same thing. This is not a fringe prediction. This is a serious, data-driven scenario that the market cannot afford to ignore. So let's break down exactly what he said and why. To understand the $309 forecast, you first need to understand one concept. And I promise, it's simpler than it sounds. It's called the gold to silver ratio. Here's what it means. Right now, if you wanted to buy 1 ounce of gold, you would need to spend the equivalent of roughly 59 to 62 ounces of silver. That's the ratio, 59 to 1. Now, here's why that number is so important. Historically, over decades and centuries of market data, this ratio has not stayed at 59. It has moved dramatically lower during major precious metals bull markets. In 2011, during the last great silver rally, the ratio compressed all the way down to 32 to 1. And in 1980, during one of the most extreme silver events in history, it dropped to just 14 to 1. What Widmer is saying is simple. If the ratio compresses toward those historical lows again, silver would have to rise dramatically relative to gold. And with gold currently trading near $4,500 to $5,000 per ounce, the math produces some staggering silver price targets. At a 32 to 1 ratio, silver hits $135. At a 14 to 1 ratio, silver hits $309. Now I want to be straight with you here, because I think honesty is what separates a channel worth watching from the noise. Is $309 guaranteed? No. Widmer himself said clearly, and I want you to hear this, that $309 represents a potential cap, a stress case scenario, not a central prediction. He is not saying silver will definitely hit $309. He is saying the market should not dismiss that possibility outright, especially given the current supply and demand dynamics. Think of it this way. A weather forecaster doesn't guarantee a storm, but if they say there's a serious probability of one, you take it seriously and you prepare. That's what Bank of America is doing here. They are putting a number on a scenario that could happen, and they are backed by real verifiable data to support why it's not as crazy as it first sounds. So what is that data? Let's get into it. Here's the part of this story that most mainstream media glosses over, and it's arguably the most important part. Silver is running a deficit, and not just for 1 year. The Silver Institute, the most respected research body in the precious metals space, has confirmed that 2026 is expected to be the 6th consecutive year where global silver demand exceeds global silver supply. 6 years in a row. The projected shortfall for 2026 alone is between 46 and 67 million ounces. And here's what that really means in plain language. Every single year, the world is consuming more silver than miners are pulling out of the ground. The gap is being filled by drawing down stored above-ground inventories. But those inventories are not infinite. In 2025, London silver inventories dropped sharply. Spot prices rose above futures prices, a condition that only happens when physical silver is genuinely scarce. And lease rates, the cost to borrow silver, hit 39%. That is not a sign of a healthy, well-supplied market. That is a market under serious stress. Some of you might be thinking, well, if silver is so valuable right now, why don't miners just produce more? It's a fair question. And the answer reveals one of the most important structural features of the silver market. Roughly 70% of the world's newly mined silver does not come from dedicated silver mines. It comes as a byproduct of mining for other metals, copper, lead, zinc. which means silver supply is essentially hostage to the economics of those other metals. If copper demand slows, copper miners scale back, and silver production falls with it, even if silver prices are screaming higher. On top of that, the pipeline for new silver mining projects is dangerously thin. New mines can take anywhere from 10 to 15 years to develop, permit, and bring into production. So even if a mining company decided today to build a new silver mine, it would not produce a single ounce of silver until the late 2030s at the earliest. The supply side of this equation is structurally constrained in a way that cannot be fixed quickly, and that is a major part of why Bank of America's forecast deserves serious attention. Now let's flip to the other side of the equation, demand. And this is where the story gets genuinely exciting. Silver's industrial demand is not a trend. It's a structural shift that is locked in for decades. Every solar panel built anywhere in the world uses silver in its photovoltaic cells. Global solar installations hit a new record in 2025, and that pace is continuing in 2026 as countries rush to meet clean energy targets. Electric vehicles use silver in their battery management systems, charging infrastructure, and onboard electronics. And here's the angle that almost nobody is talking about yet: artificial intelligence. AI data centers require enormous amounts of electronics, and those electronics require silver. As the AI revolution accelerates, the demand for silver and technology infrastructure is quietly growing in a way that was not part of the equation just 3 or 4 years ago. You have a metal that is simultaneously a safe haven investment, an inflation hedge, and an essential industrial commodity for the technologies that are defining the future. That combination is genuinely rare. And it's one of the core reasons why Widmer's forecast, as bold as it is rooted in real fundamentals. If you need proof that silver is capable of extraordinary price movements in short periods of time, look no further than what happened at the start of this year. On January 29, 2026, silver hit an all-time high of $121.88 per ounce. Then, within days, within less than 2 weeks, it crashed 36% to $75. A 36% crash in less than 2 weeks. For context, that kind of volatility is normally associated with cryptocurrency, not precious metals. Analysts describe silver's price action as behaving more like a crypto altcoin than a traditional commodity. But here's the thing. Even after that brutal crash, even after losing more than a third of its value in days, silver still recovered. It climbed back above $80, and year to date, it remains significantly higher than where it started 2026. That tells you something important about the underlying demand for silver. The buyers are real, the demand is structural, and when silver dips, people are buying it. The question is not whether silver will be volatile. It absolutely will be. The question is what direction the longer-term trend is pointing, and the evidence suggests it's pointing up. Widmer's $135 scenario is based on the 2011 precedent, and it's worth spending a moment understanding what happened then, because the parallels to today are striking. In 2011, silver went on one of the greatest runs in its modern history. From the summer of 2010 to the spring of 2011, silver tripled in price, while gold gained roughly 80% over the same period. Silver dramatically outperformed gold. The gold-to-silver ratio compressed from above 60 to just 32 at its low. Investors who held silver through that period saw extraordinary returns. And here's the uncomfortable truth that Widmer is pointing out. The current setup, high gold prices, elevated gold-to-silver ratio, ongoing supply deficits, strong industrial demand, looks structurally similar to what existed before the 2011 run. The ratio today sits between 59 and 62. In 2011, it compressed all the way to 32 before the cycle peaked. If something similar happens this cycle, with gold now trading near $5,000 instead of what $500, the implied silver price is not $50. It's $135. That is Bank of America's base case bull scenario. Now, in fairness, Bank of America is not the consensus view on Wall Street, and I think it's important you know that. A Reuters poll of 30 analysts set a median silver price forecast of $79.50 for 2026. Most major bank forecasts are clustering between $79 and $90 for the year. Only a handful of outliers are projecting prices near or above $150. So Bank of America's upper target of $309 stands in a category essentially by itself. But here's what's interesting about that. The consensus was also wrong about silver in 2025. Most analysts going into 2025 expected silver to trade in a range of $25 to $35. It ended the year up roughly 150%. When markets are driven by structural deficits, geopolitical shocks, and surging industrial demand, consensus forecasts built on historical averages tend to miss badly. I'm not saying $309 is coming. I'm saying the people who dismissed silver in 2024 and said the fundamentals didn't support a rally were wrong. And the fundamentals today are stronger, not weaker, than they were then. No analysis of the silver market in 2026 would be complete without acknowledging the geopolitical backdrop because it is directly affecting supply chains and investor sentiment simultaneously. The situation involving Iran and the Strait of Hormuz has added a significant risk premium to commodity markets broadly. Energy price spikes from Middle East tensions drive inflation fears, and inflation fears drive demand for hard assets like silver and gold. Meanwhile, China's strategic positioning in raw materials markets, including restrictions on certain exports that affect mining operations globally, has added another layer of supply uncertainty. These are not small, isolated events. They are major geopolitical fault lines that have direct consequences for the metals that underpin modern industrial and financial systems. And silver sits at the intersection of all of them, as an industrial metal, a monetary metal, and a store of value. When the world gets uncertain, silver's multiple roles make it uniquely sensitive to exactly the kind of conditions we're living through right now. Here's a scenario that Bank of America specifically flagged, and it's one that most casual investors have never considered. It's called a physical squeeze. Here's how it works. Most silver trading happens on paper, futures contracts, ETFs, derivatives. The amount of paper silver that trades every day is many times larger than the amount of physical silver that actually exists in warehouses. If a moment came where a large number of buyers all tried to take physical delivery of silver at the same time, rather than settling in cash, the system would struggle to meet that demand. We saw a version of this in 2021 with the Wall Street Bet's silver squeeze attempt. It didn't fully materialize that time, but the conditions for a genuine physical squeeze, tightening inventories, growing industrial demand, speculative interest, are more advanced today than they were then. If such an event were to occur, prices would not move in an orderly fashion. They would move violently, rapidly, and in a direction that would shock most market participants. This is part of what gives the 309 scenario its theoretical plausibility, even if it remains an extreme case. Okay, so we've covered a lot of ground. Big numbers, historical ratios, supply deficits, geopolitical risks. But what does any of this mean for a regular person sitting at home trying to figure out if silver belongs in their portfolio? Here's my honest take. Silver is not a get-rich-quick trade. Anyone who tells you otherwise is not being straight with you. January 2026 proved that silver can drop 36% in 2 weeks. If you're putting money into silver, you need to be prepared for that kind of volatility. But if you have a longer time horizon, if you're thinking in terms of 1 to 3 years rather than 1 to 3 weeks, the structural case for silver is genuinely compelling. Supply is constrained, demand is growing, deficits are piling up, and the gold to silver ratio suggests silver is historically undervalued relative to gold. For investors who want exposure to silver, there are several ways to do it. Physical silver, coins and bars, gives you direct ownership. Silver ETFs like SLV give you exposure without the storage and insurance costs. And silver mining stocks offer leveraged exposure to silver prices with higher risk and higher potential reward. Do your own research, understand what you're buying, and never invest more than you can afford to lose. Zoom out for a moment, because I think it's important to understand where silver fits in the broader financial landscape of 2026. We are living through a period of significant transition. Central banks around the world have been buying gold at record pace, moving away from reliance on the US dollar as a reserve asset. Inflation has proven more persistent than most economists predicted. Interest rates are expected to remain elevated. And geopolitical tensions, from the Middle East to US-China trade friction, are not going away. In this environment, real assets, physical things that can't be printed, things with genuine utility in the real world, are becoming increasingly attractive to serious investors. Gold has already responded, hitting levels above $4,700 per ounce. Silver, which historically lags gold in these cycles before catching up sharply, is now beginning to move. When the gold to silver ratio eventually normalizes, as it has in every previous precious metal cycle, the move in silver tends to be fast, large, and surprising. The investors who are positioned before that happens tend to do very well. The ones who wait until it's front page news tend to arrive too late. So let's bring this all together. Bank of America, one of the world's largest and most respected financial institutions, has put a $309 silver price target on the table for 2026, not as a guarantee, not as a certainty, but as a serious, mathematically grounded scenario that the market should not dismiss. Behind that forecast is a real story. 6 consecutive years of supply deficits, structurally constrained mining production, surging industrial demand from solar, EVs, and AI infrastructure, and a gold to silver ratio that history says has significant room to compress. Is 309 coming? I genuinely don't know. Nobody does. But I can tell you this. The investors who asked that same question about $100 silver in early 2024, when silver was at $25, and decided the answer was yes, have already made extraordinary returns. The question now is whether the next leg of this story is just beginning, or whether we've already seen the best of it. That's the debate worth having, and I'd love to hear where you stand. Drop your silver price prediction for end of 2026 in the comments below. Are you a bull, a bear, or somewhere in between? Hit that like button if this video gave you something valuable, subscribe if you haven't already, and I'll see you in the next one.